Hi, this is John from I Will Teach You to Succeed. Today we're going to take you through the quick start of the Plan100X Small to Medium Enterprise Visual Business Planning Tool. Before we start, why not click on the subscribe button below and also on the bell if you want to be notified of when we produce extra videos and put them out there. Right, so firstly we're going to take you through the Plan100X toolkit. The first thing you'll get in that toolkit is the business planning tool itself. Secondly, there's an end user license agreement. Please read that. This tool is for a single user. You may not distribute it to friends or colleagues. Obviously, you can use it for multiple businesses, but it is for a single user. Thirdly, there is the user guide, a 60+ page user guide taking you through the entire business plan. It should really be able to ensure that you have no issues in completing the Plan100X business plan. Right, and fourthly is the Microsoft Excel guide. We give this because Plan100X is formulated, based, developed on Microsoft Excel, and that's where it works best. We would like you to use Microsoft Excel. We cannot guarantee results on any other spreadsheet platform. So there is a free version of Microsoft Excel in this guide. It is only for 30 days, extendable for a further 30, but at the end of it you might want to buy Microsoft Excel for use, for ongoing use, as well as there's also an online version. Not recommended. There are some formatting issues with that, but it could be used in order to run the Plan100X tool. So in terms of the business planning tool itself, firstly it's a comprehensive business plan. There's no need to go and look for templates and spreadsheets. Everything is contained in this single tool, from company and industry, marketing, products and services, including a very powerful costing module, operations, sales and distribution, a SWOT analysis, financial, goals and objectives, and lastly appendices, so you can append any other documents you may want onto your business plan. In terms of financial statements, a 12-month and 4-year profit and loss statement, 12-month cash flow statement, capital funding, tax liabilities table, financial analysis, balance sheet, and financial ratios. Also, in terms of the visual business planning aspect of this tool, there's a graphical outputs. We have a 4-year view, revenue, profit and loss, cash flow, and many, many more. So the quick start, this is designed to, within 30 minutes, give you an idea of the financial viability of a product or service. So you will need your product and service costing. Obviously you've done some work in terms of what it would cost to produce the product or service. You will need that. You'll also need to give an estimate of sales over 12 months, and you'll also need to know what the overheads are to run the business. In terms of financial statements that you'll get out, 12-month and 4-year profit and loss statement, a cash flow statement, financial analysis. The graphical outputs is 4-year view, revenue, cost of sales, indirect costs, and gross and net margins. Very, very powerful for just 30 minutes of work. So on the right here you can see an example of a financial statement. This is the 12-month profit and loss, and then a view of the 4-year view, which is showing you your income, your cost of sales, your gross margin, your indirect costs, your net margin, and then your taxes for all 4 years, as well as a tabulated format below. Right, so we're going to get right into the quick start. I'll see you on the other side when we're in the tool. Okay, so here we are in the Plan100X business planning tool. And before we get started, let me just point out that whereas this is where you'll come into the tool, this is what the first screen will look like. Sitting above this is the executive summary. Now, the executive summary is normally done at the end of the business plan, and it's quite a bit of work to actually go through your business plan and extract what you deem necessary to be in that one-page executive summary. Plan100X has done that for you. So as you go through your business plan and populate it, this executive summary will call on the information. You can see now a lot of the fields are empty. That's because you haven't put the information in yet. I've started to work on this so you can see some information here, but at the end of your business plan, this will automatically populate from what you've already input. What's also important, on the right here you can see it says only input gray cells. With very few exceptions, it's only the gray cells where you need to input data. All the other areas are locked down. You cannot get into the other areas if using Microsoft Excel. Also, on the right-hand side, to the right of this line, is what does not appear on the business plan itself. This is all help on the right-hand side. Firstly, this is a 5-product version. Plan 100X comes in a 5 and a 10-product version. We're using the 5-product version today for this quick start walkthrough. Also, on the far right, there's help, the yellow tabs. Every single step of the way through the business plan, there is help. If you click on the help tab and look at the number, you will be able to get help for every single step of the plan. Important note here is a disclaimer from ourselves. We've done everything in our power to double check the calculations, and we are 99.99% sure that everything is working perfectly. However, we do suggest and require that you run your business plan, particularly from a financial modeling perspective, past your company accountant, your business consultant might be, in order to check out the business plan to make sure that the numbers are making sense, that how you've input your various sales data and financial data is making sense to you. Right, let's get started. The first thing you're going to do is input the financial year. So here you just input 2019 and then your company name. So you can see that as I enter that, it changes the name above here. We've called this company Digital Products. A brief description. Because we're doing the quick start, I didn't mention that, but the quick start is all these pink colored indicators on the right hand side. You only need to input these sections. So up top is version 1.0, then January. So we've said the month start is January. It could be any month, bearing in mind that whatever month you choose, all your tables and your graphical outputs will align with the start month you select here. So we're choosing January to keep it simple, right? So now we're going to just scroll down to the next quick start entry, which is this one here. It's your tax rate, your corporate tax rate. It will depend on what country you're in as to what tax rate you pay. So we've got 25% in here, and you change that to suit your country, and we've just input as well that you're using US dollars. So down we go to products and services. Right, so here we are in the products and services. And if you look again at the quick start indicators on the right hand side, these pink sections, all you have to do here is input the product name and description. I've called this a personal budgeting tool, and I said it comes with a notebook for keeping track of expenses. I've said a notebook because I want to include something physical that's got a cost attached to it, as well as something that I need to ship, because I'm going to show you how those work. Also here, you can see that there are 2 price points, price point 1 and price point 2. You will see a number in here of 120. I can't access that because it is a calculated sell price. Let's just scroll down a bit and I'll show you where that comes from. So in terms of the product and service costing, remember I said to you in the start of this presentation that you needed to have your product and service costing available. This is where you input it. Remember, the gray cells are the input. So we've got place here for 5 separate costs. If this is not adequate, you can go to the end of the tabs and go to the detailed costing sheet. Now, the 5 that I showed you just now would relate to these 5 categories. And when you enter these categories here, I've still kept this data in here. Obviously, it doesn't apply to digital downloads or digital products, but I've just kept this from a furniture company where they were selling bar stools, and you'd input the stock keeping unit, the description of the cost item, and then the category. You need to input a category in order for it to add up. If you don't put a category in, it's not going to add, and then it won't work. So we're going to just leave that in as painting, So there you can see how it works, and we're going to take these items through. There you see 4. We can have as many as 5 here. Take them through back to the main Plan X product service costing and input those 4 or 5 values, descriptions rather, and 4 or 5 values here. Now, when we've put them in, so here I've got notebook at $15, and I've got development cost amortized. So these are costs that I've spent developing this product, and I'm going to amortize them over the life of that product. I've put that in as $25 that I'm recovering per sale. The batch size is 1. Now, why do we have a batch size? Well, the batch size is, let's use an example. If you were making some product in bulk, and so your costing would be in the form of a bulk manufacture, and then that bulk manufacturer might have 30, let's call it, products that come out the end. Then you would input 30 here, so all those costs would be divided by 30 to get to a product cost. In this case, our batch size obviously is only 1. So the next item to input, remember the gray cell here, is 200%. I've used 200%, which is not a bad margin for a digital product, and giving us a sell price of 120. Now, if you remember, this 120 is the calculated sell price sitting up top here. That's where that comes from. Now, in terms of price point 2, on the left, we could well put another markup in here, and there 250%, giving us a sell price of 140, and there you can see the difference in our gross margin. What was 80 at price point 1 is now 100 price point 2, and the same in terms of the percentages. We're making more gross margin percentage with a higher markup. So suddenly at the top here, there is our new price point 2. What I'm going to show you at this point in time is that the orange cells, you can override these price points. So maybe 120, the calculated sell price isn't the number that I want to sell it at, and I want to sell it at $129. Now, Plan X will use the input price over the calculated sell price. Big reminder here that you are using an input sell price to remind you that it's not calculated. I'm going to leave it at 0 for now and use the calculated sell price, and I'm going to take out this price point 2. We don't need it. So here are your 5 products, 1, 2, 3, 4, 5. We've only used 1. If you need to add any notes that you need to have as reminders in terms of how you costed these products, there is room to add that in here. Maybe it's a good time just to let you know that if you need to get any kind of support on this tool, you just use this URL. It'll take you to our support desk, and there's multiple forms of support. There is a wiki in terms of different support items. There you can log a support ticket. If there's a call center agent online, you can ask for help from that agent immediately. So that's how that works. The next thing we're going to do is look at the product and service development cyclical cost table. And what this allows for is costs related to the product throughout the year, but not in terms of manufacture of that product. So we use here, for example, with this first product of ours, this personal budgeting tool, we're putting in a cost unit of $1,000. And then we're indicating at what points throughout the year, or year 2, year 3, year 4, in terms of the quarters, we're going to be incurring those costs. So I've said here in the month of May, I've got a $2,000 cyclical cost, and that needs to be accrued for and accounted for in our profit and loss. So you can see May, the number 2 multiplied by that 1,000 would be $2,000, I beg your pardon, and the same for quarter 2 in the years that follow. Right, we're going to move on now to the next section below here, which is the marketing budget and website budget. Right, so with the marketing budget, I've pre-populated this with some costs. This is any item you might need to put in terms of the marketing budget. We've put 3 items in here: social media advertising, media advertising, and promotional material. Obviously, you can input any other marketing costs you might have throughout the year. This marketing budget, as we have it right now, totals $4,150. The website budget is a little bit different. Here again, we've got standard cost items and then others that you can add, and we've populated that across the 12 months, giving us a total of 3890. You'll see these numbers come up in the profit and loss statement below. So moving down on the operations plan, we're looking at staff, personnel, and here really at the moment we've just got yourself as the CEO, and we've got a salary in there of $5,000, and we've got it in as one person obviously across the 12 months. If you wanted to add another person, you can easily do that. Let's just say you had a manager in here, and they're going to be paid $2,500, and we're going to only bring them on in May, and you can see your head count at the bottom starting to add up as that person comes on board. I'm not going to add this person in right now, so I'll just delete them. So the next thing to do is to look at staff benefits. So these are expenses over and above the person's salary in terms of what the staff, I beg your pardon, in terms of what the company is paying that staff member. So I've got it in 12.5%, and it includes anything in the form of pension, whatever the company contribution to that staff member might be over and above their salary. Okay, so I've got myself in here, or you as the owner, at $5,000. 12.5% is company contribution to staff benefits. It does not include the normal pay-as-you-earn type tax and that kind of thing, which comes off the staff member's salary. What's probably important as well is to look on the right-hand side at these year one margin indicators. What's good here is to see that while you're adding staff members, let's just say that we had another staff member at 5,000. I beg your pardon, 5,000, and I want you to watch what happens to this net margin as we put. So let's have 5 of these people joining the company. Can you see that in 2 months we have gone from a positive net margin to a minus net margin? So that means we got to be very careful adding heads. They can cost the company a lot of money and can really affect your net margin. Right, so moving down to this next section, which is shipping cost. That's the next quick start input, and I've kept this at 3.5%. You need to work out what your shipping cost would be. Remember, we said we have a notebook which we need to manufacture and then ship. So I've said the cost of shipping that notebook would be 3.5% of the sales revenue, not the cost, the sales revenue. And that's the number that I've left in here. Right, so moving on to the sales and distribution plan. In the sales and distribution plan, remember I said to you that the second item you would need in completing this quick start was a sales projection across the 12 months. Well, here we have it, and you can see on the right hand side the quick start indicator, this pink section. This is where we need to put this information. And so we have one product here, and it is at price point number 1, and we're going to put in what we think is the sales number. It's 200. Normally you'd ramp this up a bit, so you might start 50, 100, 200, but I've just put in, for purposes of this example, 200 across the year. Quite important to note here is that we have the ability to put in seasonal sales trend. So it could be that certain times of the year, it might be over the festive season, something like that, where we see an increase in sales, and this allows us. So here, remember we said we're starting in January, our first month of the financial year, and we are deciding that in September and October, we're going to up about 20%, and then we're going to drop it down in November to 90% of the sale. So we straight line the sale across the year. The seasonality will pick it up and drop it down again. Also on the right hand side, we have an allowance for worst case scenario. I have downgraded my sales projection by 25%, meaning I'm only taking 75% of this number. So in any 1 month here of 200, I would only take 150 units and use that to base the financial viability of this company on. Entrepreneurs, very often when they start at businesses, they overstate sales, they're very bullish, and this allows us just to downgrade that sales projection slightly, and anything above that obviously is cream on the top if we're making profits. Moving down, we have commission payable on both price points. So in all of these products, here we've only got one, but in all the products we would be able to set a commission payable if you had agents or sales staff for both of these price points. And also on the right here, you'll see that we have the days after the date that the sale was made, the month that the sale was made, when you pay commission. Normally it's 30 days, and then that would allow for payment of that commission 30 days after the sale was made, right? So now, also quite importantly here is to look what's happening with your gross and net margins as you start to increase or decrease sales. If I drop this down, let me just show you what happens when I drop this to 50%. Straight away my net margin goes right down to minus 7.3%. Not very good. Right, so let's put that back up again to where it was. This is your input. Remember, the gray cells input is gray. The sales revenue forecast, which you're seeing here, takes this 200, goes up, finds the 120 sell price, reduces it by 25%, and puts that number in here. So 200 times 120 is 24,000, and 75% of 24,000 is the 18,000. That's how we're getting to that number. The same is done across the year. Remember, we said we're going to increase by 120% in September, October. We're going to decrease by 10% to 90% in November, and that gives us a total for the year of $221,400. So here's the first graphical output, which you can see, which is your sales forecast across the year. There's the step up, step down. So what you can see here is that only one product is showing. However, it does make provision for all 5 products. If all 5 products were showing here, you'd see 5 different colors in these bars, indicating the different products and the makeup of your sales in terms of the 5 different products. Also, your sales forecast on a cumulative basis is good to look at to see how many sales you're making across the year on a cumulative basis. So moving down, the next section we're going to get to now is the financial plan. So the first part of the financial plan is startup costs. We've got 6 categories allocated here: building and real estate, leasehold improvements, capital equipment, location and admin expenses, advertising and promotional, and contingency. Now, for purposes of this, we've allocated some funds towards painting of offices at $1,000, cleaning of carpets at $200, and we've got a contingency in here of $1,000. Again, you can see by the right hand side, these are needed for the quick start. Also, what we need to do is to tell Plan100X if we want to include these costs in the first month. We've said the first month is January, and you can see here, you'll see these costs coming in at the bottom of the cash flow statement in the month of January. If we say yes, we can say no, and then that would keep it out of the cash flow. I suggest keeping it in, but obviously it depends on where you want to reflect these costs. So moving down to the next input for the quick start is tax, VAT and sales tax. And here what we need to indicate firstly is the months you pay your sales tax. In some countries you don't have to pay every month. You still pay your tax, but you don't have to submit every month. You submit every second month. In some countries every third month. So here you'd simply indicate if you're paying tax in the month. What Plan100X does, it looks at this input here, and then it calculates the tax payable for you in the certain month. So no surprises. Again, entrepreneurs very often get caught out in terms of not paying the taxes needed, and can find themselves in hot water. So with this, we've got feedback from our users, and we've built a tax liability table that shows you exactly what tax you're going to be paying in what months. Very, very useful, very powerful. Secondly, you're going to put in here the sales or VAT percentage. I've put in 15%. In some countries it's higher, in some countries it's lower. You'd need to put the right percentage in for your country. We've also got an allowance for other sales taxes. So there's two of them, other sales tax 1, other sales tax 2. It depends on what country you're in as to whether the suppliers, in some countries, let me give you an example, there's a thing called withholdings tax, which applies to professional services. So if you go into a country as a consultant, you often you aren't subjected to normal pay as you earn type taxes, and so what they apply to your invoice is a withholdings tax, and that can be as much as 12 or 15%. So there is allowance for you to add in 2 other types of sales tax, which is over and above your normal VAT. Also, what we input here is staff bonuses. With a startup, you're probably not going to be paying staff bonuses out. If you're making a lot of profit, you might want to. So here we can indicate whether we are paying a staff bonus, what percentage of the gross monthly salary of your staff members, and what month you're going to be paying that bonus in. So you can select the month of the year. It might be December when that is paid. In this case, we're selecting no, 0, and no month because we are not going to be paying any staff bonuses. So moving down to the financial statements, the first thing we see is the 12-month profit and loss statement, and we're starting to see some results. So in terms of what we've input above, which is your sales forecast and costing, and obviously the cost of sales coming through, we can see what's happening here. We've got a sales line, if you remember, was 221,400. Now we've got a cost of sales of 81,549. That includes your 3.5% of shipping. Remembering your shipping is a percentage of the selling price. So it ends up with a gross margin for the year of $139,851, 63.2%. Very nice, very healthy. Now we start inputting again for the quick start, looking at the pink color on the right hand side. You may input everywhere where there's gray. So we have suggested certain descriptions of indirect costs being your overhead costs for your business. I've included outside services, $1,500 a month, totaling 18 for the year. Here are your 2 costs coming from above, your 2 budgets for website and marketing. Remember those numbers, 3890, 4150. You cannot input them here. You have to put them in above. And so you go through this. As I said, I've input certain amounts. I've put in for telephone, I've put in for miscellaneous. Obviously, there's a lot more costs that you'd have to go through. Again, what's important to note is this year 1 margins indicator on the right. If we have to add in here, and let me just use a number here just to show you, I want you to watch what happens when we start to add in. Let's put $50,000 in here as a one-off payment. You can see, boom, straight away we had minus 14,000 net margin, minus 6.4%, which is this number here. So obviously our gross margin doesn't change because that's above our indirect cost line, but this 50,000 will have a major impact. And so it allows you to see, as you're adding these numbers up, what the impact is on your gross and net margin. Right, moving down, you can see that there is a provision for tax for year 1. It's calculated your profits for the year, and it's taken, remember we input our tax rate at 25%. That's what you're seeing here. Tax provision for year 1. No surprises as a new entrepreneur just starting out. Then we have, very importantly, the break-even sales. Break-even sales indicate the sales you need to achieve in order to cover these overheads on a monthly basis. Now you can see that this is showing green, which is really good. We're in the positive. $17,288 was needed to cover these overheads for the month, and guess what? We've done $18,000. So we're $712 to the good, meaning we've done more than we needed to, and the same applies across the year. So moving down, we're going to look at the remainder of the inputs for the quick start, and this is at the 4-year profit and loss projection stage. So in the 4-year profit and loss projection, there's very little to input. You'll see on the right the quick start color, this pink, and really what we're doing here is we just inputting the quarter-on-quarter increases for the 3 different sets of numbers. The first one is your sales increase quarter-on-quarter. I've set that at 5%. It's probably a little bit high, but as a new business, it's quite possible. I've aligned the product cost, meaning the cost of sales, with that also at 5% increasing. But then I've kept the indirect expenses at a slightly lower increase at 2% per quarter. And the effect that that has really is that your gross margin has stayed the same year on year. But what's happened is that you can see at the bottom here is that the net margin has increased because we've managed to maintain a lower increase of your indirect costs. But anyway, back to the top, how do we get to these numbers? What's happening here is we are using the last quarter. If we look up top in the 12-month profit and loss, we're using the last quarter, these last 3 months, the average of those 3 months, to project the next quarter, which is year 2, quarter 1. So we take those last 3 months, we average it, add 5% on, and put it into the sales number here. And the same for everything. So the same for sales, same for cost of sales, and the same for your indirect costs. These get increased on a quarter-by-quarter basis. Now, what's happening, if you look at the right-hand side here, very interesting, you can see what's happening. Year 2, gross margin, net margin. Year 3, gross and net. Year 4, gross margin, net margin. This is what you should be making if you're able to achieve these increases on a quarter-by-quarter basis. So let's just have a look here, for example, and I want you to see how powerful this tool is on the right here. If we had to increase this to, say, 15%, I want you to see what happens in year 4, right? It increases everything dramatically. So straight away, your gross margin has gone up and your net margin has gone up, right? If we return it back to where it was, you can see it goes back down again to 29% net margin. Anyway, so that's what you do. So there's nothing else to input here. And again, some great results out the bottom. We can see the break even on a year-by-year basis. So there's our quarter break-even numbers. And the annual break-even at the bottom here, all in green, all looking really good. Moving down to the tax liability table. Now, there's not much to do here either. There's nothing to input. All this data in the tax liability table is derived from what you have input thus far. So there's 2 kinds of taxes in terms of sales tax. There's output, which is the O, and input, which is the I. Now, if you look at the top here, the first one is output sales tax. This is sales tax from selling, and that's the top line, total of $33,210 for the year based on our sales projections. Then we have an input tax on our cost of sales and an input tax on our indirect costs. So these are coming through here, and you can see the totals on the right hand side. Well, that's our total sales VAT tax payable by month. You'll remember that we had those other sales taxes, the 2 other sales taxes. We have we put in 0, so these are showing 0, and so the total tax payable at the bottom here is your 911, 1316, etc. as we go across the year, a total of 15,512 for year 1. The same thing applies for year 2, 3, and 4, so you're able to see well in advance of these tax years what you will be paying by month, and then for these following years by quarter. Importantly, at the bottom here, the tax payments. Remember, we told the tool that we would only be paying tax in February and May and August. That doesn't mean we're not paying tax for January. It just means that it's accumulated. So the 911 gets added to the 1316, and there we get the 2228. And then we don't pay tax for March and April, and then these 3 months get added again, and we pay 3634. So that's how it's working, and very, very useful because there's no surprises. Right, we're going to move on next to the cash flow statement, which is a very important part of this exercise. So the cash flow statement is a little bit different to what we've seen before, in that what it's doing is it's letting you know how much cash is available in the business at any one time. And obviously it maps quite closely to your profit and loss or your income statement. The important thing to note here is the first input at the top for the quick start is what is your pre-startup funds? How much money are you going to be putting in the business before you start? If we've taken that to 0, you can see what's going to happen is that we start off with in January with a negative balance. One of the reasons for that, if you remember, we had our startup costs They're sitting at the bottom, those $2,200 of startup costs. We've included that in the first month, which happens to be January. We're going to keep that funding at $20,000, assuming that you've put that level of funding into the business, which makes the cash flow look a whole lot better. The only inputs at this level, cash receipts, if you're sure of any cash receipts coming in, bearing in mind that any cash sales at this point do not impact cost of sales. So I want you to be aware of that. There's no provision in terms of these monies received, in that if you had to sell a product for cash, it doesn't accrue any costs in terms of cost of sales. So just be very aware of that. This is cash coming into the business without any expenses. So what are we doing here next? We are putting in any terms for collections. Now, what that means is, if we're starting a business, we don't really want to give terms, and I'll show you why. What happens here is everything goes south quite quickly. If we had to give our creditors, people that are buying from us, terms, 90-day terms, they only pay us in 90 days, this is what would happen to our business. Everything turns red. Not good at all. So you do not want to give terms. The tool does allow, though, if we had to do 60% sales at 0 days, and we had to do 40% of the sales at 30 days, it doesn't look that bad. We could give a certain amount of terms, and that's why we've given these multiple lines here for allowing terms. You could have different parts of your revenue at different terms. For what we're doing right now, we're just going to leave that at 0 and 0. Take that back to 100, and so all of our sales are sitting at 0% terms. Right, so if there's any other income, you can put it in this line. Remember, we said the gray is the input. And then down to cash paid out. The cost of sales obviously is going to be there on a month-by-month basis as we sell. And again, what happens here, opposite to collections, is that if we get terms, our cash flow starts to look better. So just look at the top of the page now. You can see what happens if we give 60-day terms. The cash flow suddenly starts to improve, because we haven't had to pay in months January and February. Well, we can do the same here throughout, and going down. Let's just say we were using an outside service, a marketing company, let's say, was giving us on a monthly retainer, and we would put in here, let's just say 60-day terms. You can see what happens at the top here. It improves the cash flow. Okay. Right, so moving on down, you can see all the way down we can put terms in. You probably won't have too many terms across all of these. I mean, rental is payable immediately, etc. If there are any other non-profit and loss payments that we need to put in, for example, loan repayments, capital purchase, other startup costs, then that's where these would go in at the bottom here. So at the end of the day, we end up with a cash flow. Obviously, what we're looking for is green. We want it all to look good. When it starts to look red, as I said just now, if you start to give terms, that is not a really good cash flow situation, right? Okay, so that is the cash flow. Now we get down to the capital funding plan, and I've put this after the cash flow because this is the point where you'd be able to determine whether you need funding. Let's say, for example, let's go back up top here. Let's just say we put in no money into the business, and let's say that we gave 30 days credit. We need money. And if we look along the top line here, the worst case scenario really is when we start the business, and that's $21,539 in debt. So we know that we would need funding. At this point in time here, you could say you go into your bank, let's call it Bank 1, and we're going to get $30,000 of funding. Well, what happens now is suddenly everything turns green again because your funding is showing at this level. So you can just see a good example of how to use the tool, using the funding capital tool plan here to put funding into the system and take away those awful cash flow situations that you have. Right, so we're going to put that back to 20,000, and everything looks good. So that's the capital funding plan. That's for year 1. Obviously, we can also do for year 2, 3, and 4 if we had problems with our cash flow in any of these years. We could put funding into the business from investors or banks. Next up is the financial analysis, and that's really powerful. It's a really small table, and it reflects everything of value, so to speak, that is coming out of the financial results we've shown above. So the first thing is the sales units and the revenue. Bear in mind, you see these little asterisks here. What that's saying is that your sales revenue and cost of sales are reduced or increased to take into account the worst case sales scenario and seasonality. So even though we're projecting sales of 200, remember that the sales revenue might not reflect exactly if you take the product cost and multiply it by the the sell price, I should say, and multiply it by the units. You won't get the actual revenue because that's been altered according to worst case scenario and seasonality. So there's your cost of sales again, gross margin coming through. Look at the end of the year here, 139.85, 163.2%, looking really good. Our indirect costs, 103,940, giving us a net margin of 16.2%, which is 35,911. So all looking really, really good. Break-even analysis for the year, all in the green, fantastic. Monthly tax, we know what we're paying. That's our monthly payments. There's the 2228. Remember, we saw that above, etc. across the year. So these don't align exactly because obviously we're paying tax every 3rd month, and there's a little bit of a misnomer at the end here in terms of when the tax is paid and what is actually due. So it's close but not exactly the same. Funding, we're not requiring funding at this point, so that's all zeros. And then obviously the most important line of all is total cash available. So that is your financial analysis, and a lot of these figures go up to the executive summary at the top. We'll go back up there just now and take a look. Right, and then at the bottom, we're not going to put in the balance sheet now because that is something that takes quite a bit of work and not really needed right now in terms of looking at the financial viability of your product or service. At the bottom here also is the financial ratios that come out of the balance sheet. We also wouldn't be looking at that right now. There's financial assumptions. We're not going to write those in. And obviously any appendices. There's your goals, short-term goals and objectives. And very importantly, we're just reminding you here to consider any actions coming out of the SWOT analysis. At the very, very bottom of it all, we've just kept a, this doesn't print out, by the way, this is just sitting at the bottom of the tool, is a note of all the revisions. So we said we're on revision 1.0. This is the quick start. Our name is David Blake, and that's the date that we did it at. So that is the tool. What we're going to do now is we're going to move on to the various different outputs, the graphical outputs, and let you have a look at that. Right, so moving forward to the different graphical outputs, the first one we're going to look at is the sales revenue. And this really is a very powerful representation of your sales. And you can see what we've allowed for here is we've allowed a row to put your actual revenues in, because it's fine to predict the sales, but what we're showing here is the actual sales. That's the green above here, the actual sales. And there's obviously a variance. The variance is showing in the maroon color. So in the months of January and February, we were above the target for sales. We had 18,000 for each month, and we were above that, you can see. And then for March and April we were below. But what's happening is we're tracking the year-to-date variance on a month-by-month basis. So although we were 24% above in January, in February we were up even more, 28%, and then down slightly, down even more, and currently we're at 23%. As we go into May, we're 23% above what we had projected at the month of May. So that's really good. Going on to cash flow, you can see what this is showing. This is cash in, cash out, and cash available. So cash in is the blue, cash out is the green, and then cash available is the maroon color, and that's looking really, really good because that's all above the line. So funding, we know that we didn't require funding, so there's no funding showing on year 1 or years 2, 3, and 4. But look at the profit and loss. So here we have in the profit and loss statement for year 1, from January to December, we have our sales, our cost of sales, gross margin, indirect costs, and net margin. Obviously, the most important numbers here is our gross and net margin, both of them above the line. Nowhere are they dipping below the line, which is a really good sign. For the years 2, 3, and 4, the same thing. Profit and loss statement also all looking good, all above the line. Net margin very positive and looking great. And if you look at it on a 3-year basis here, years 2, 3, and 4, these are the totals on the right-hand side. Right, so moving on to this graphical output, which I really think is very useful for entrepreneurs to see what their business looks like over a 4-year period. What we've got here is we've got sales in blue, cost of sales in green. This is our gross margin, and then we've got our indirect costs, the net margin, and then the tax payable on a yearly basis. So very nice visual graphical output of the 4 years, obviously tabulated below as well, and then you can make any notes you want below that. So moving on, we have the cost of sales. So this is the monies we are paying out to have the product produced, and you can see here we have input the actual cost of sales, and what we're getting is we're getting a variance. So our sales were a little bit higher in months of January and February, which were good, and what that's done is it's pushed our costs up. We understand why it's in the red, and then we've managed to claw some of that back in March and April, and we're currently sitting in May at minus 3.2% of what was budgeted for cost of sales. In terms of indirect costs, the same thing. We have our indirect costs, the cost to run our business, our overheads, and what we're doing here is we're actually going through, remember the gray cells we can input, we are putting in the actual indirect costs, and what that's doing is telling us how we're looking on a month-by-month basis and on a year-to-date variance basis. So we've gone over slightly. We were at 14% over, managed to claw something back, currently sitting at minus 8.4% at the month of May. Right, so gross margin is looking good. We dipped slightly below the expectation in the months of March and April, but we're still 34.5% higher than what we had expected. And if you look at net margin, the same thing. We had a good January and February. March and April not so good. We were below the expectation, and but still sitting at 143.8% of what was budgeted. So very, very valuable graphics that allow you to look at your business on a month-by-month basis. And what we find is that entrepreneurs just appreciate the visual nature of these outputs rather than having to try and interpret very complicated financial statements. So what I'm going to do now is take you back and show you what this would look like as a printout, the kind of document you'd be able to take and show to your banker or to an investor. So what I'm going to do now is just walk you through the PDF printout of the PLAN100X business planning tool. And this is the executive summary, and you can see, as I said before, a lot of the information is not populated in the executive summary because that's not what we did in this quick start. But there certainly are sales numbers in, financial numbers in, and years 2, 3, and 4. And you can just see how quickly we got to those numbers. The financial ratios weren't determined because we didn't build the balance sheet. Right, so moving down, I'm going to just walk through this quite quickly because you've seen it all. But you can see how professional this looks, going through the company information, long-term goals and objectives with dates in, the pestle analysis. If you don't know what the pestle analysis is, you can learn if you look at the help guide. The products and services, there's a great page on exactly what your products and services are, what the costs are. There is the costing results from what we did with the one product. Obviously we could do for all 5. We've looked at the cyclical developmental cost table. The marketing plan, including a competitor analysis, which we didn't do this time. The social media plan, marketing budget, we did that. We did the website budget. And then we go down to the operations plan where we put the staff into the business. Right now it was only you, or the owner I should say, at $5,000. And then what we did was we input the sales across the year. Remember, price point 1, we put 200 in across the whole year. We increased it for seasonality and decreased it, and then we reduced to 75% for worst case scenario. We didn't want to include any commission, so that is 0. And then this was the sales revenue table, and below that obviously the graphical representation of sales by month, and then the cumulative sales, which looks really nice. So going down the SWOT analysis, we didn't complete this time. We should be doing it, but not now. Financial plan, nothing in yet. Now we input startup costs. Remember, we put leasehold improvements, painting of offices, cleaning of carpets. That was the $1,200 plus the $1,000 contingency makes for the $2,200 for startup, and we were going to include that in January. We told Plan100X that we're going to be only paying tax every quarter, so we put February, May, August, and November as the payment months. We then put in 15% VAT, value added tax, and we had 0 in for any other sales taxes, and we decided we are not paying bonuses. Right, and so on we go to the 12-month profit and loss statement, and this gives a great visual view of the table, and we can see exactly what our sales are for the year, what our cost of sales are. Our gross margin was at 63.2%, and there comes all the salary and payroll costs. If you remember, we added 12.5% on for staff benefits. That's why it's 5,625 and not just the 5,000. Right, so down we go. Remember, the break-even sales was all in the green, which is really great. Our net profit is sitting at 16.2%. Then the 4-year projection, if you recall, we input just the percentages, increases quarter on quarter, and that gave us a 4-year projection based on quarter 4 of year 1. We use that as the average, and we projected that forward. Again, at the bottom, net margin looking really healthy, all in the above the line, all positive, no holes in that, and the break-even sales at the bottom, all green, looking really, really good. Tax liability, this is one you want to pin up on the wall because it's so important to make sure that you pay your taxes on time, and that's what that is showing you. We went through that in detail, so I'm not going to go through it again, but that's a very nice output of what that looks like. The cash flow statement, then probably one of the most important outputs in the document, very nicely presented. And what's important here is to note that all these payments here are VAT sales tax inclusive. So if you remember, we had budgeted for outside services 1,500. Well, we have 15% sales tax. That's why we're paying 1,725. Also, the sales are inclusive of VAT. So this is not revenue, this is cash receipts, money you've received. And remember that you act as a collection agency for the receiver of revenue in your country. So that money is received by yourself and needs to be handed over at the set dates. So that's the cash flow, looking really good. There were your startup costs coming in the bottom. We go on to the funding plan. We didn't need funding, so that is zeros throughout. And then the financial analysis. So that's a really nice view of the business, and you can see exactly what's going on. Remember to read the small grey print here where I mentioned that there's not a direct correlation between sales units and revenue because of the adjustments for seasonality and taking into account the worst case scenario. We didn't type out a financial analysis, so that is blank, and then the balance sheet we left blank. So all in all, looking really good. We then go on to short-term goals and objectives, followed by all the graphical outputs. So that was sales revenue. Then we had cash flow year 1, Then we had funding year 1 and 2, years 2, 3, and 4, which we didn't need. Then our profit and loss for year 1, very nice, both visual and tabular form, where we can see exactly what the expectation is in terms of sales and profits. Profit and loss projected now for years 2, 3, and 4, also very visual, and we can see that everything's above the line, looking really good. The 4-year view, which is what I love, very simple, clean, easy to see on a year-by-year basis whether you're going to be making money. Also highlighting, of course, the orange below the line being your tax payments. Cost of sales. Here we're putting in the actuals, as I said earlier. The indirect costs, again, putting in the actuals. And so we end up with gross margin, and that is looking good. We had 2 little dips below the line, but all in all, we're 34.5% year to date above, and that's looking great. So net margin, again, 143.8% higher than expected. So that's really fantastic in terms of what we've done in achievement, sales achievement, cost achievement versus what was planned. And that is it. So that is the complete business plan in PDF format. And I'm sure you'll agree that it's highly presentable, something that you can take to the bank and ask for a loan. So really exciting to be able to present this to you. I hope you've enjoyed it. If you are looking at doing the complete business plan, go on to the other training. This was just the quick start walkthrough. Firstly, what I want to say to you is subscribe. Click the subscribe button. Make sure you hit the bell so that you get the notifications when we send out. We're going to be sending out a number of videos around this. One of them that's going to be really useful is how to do what-if analysis, okay, to look at your business plan and see how you can make more money by adjusting certain figures and certain elements of your business plan. So make sure you subscribe, click the notifications little bell, and you'll get the notifications when we send these videos out. Otherwise, if you are doing the full business plan, going through it in detail, go to the other training where we're going to step through everything. It's detailed training, and I suggest you have that training open when you do your business plan. So you have the video running on the one side, you've opened your PLAN100X document, and you're working through it. All right, so that's all for me. It's been great to be able to present this to you, and all the best with your business. I wish you much success. Okay, so one final thing from my side. Why don't you subscribe to Team Success 100X? You'll get weekly updates in areas that you want to hear about: life, career, business, online, and wealth. So go onto our website, iwillteachyoutosucceed.com/join Success 100X-team. And sign up, and we will keep you up to date with all our correspondence, blogs, newsletters, and keep you in the loop, particularly now with regard to the Plan 100X. See you soon.